So welcome folks to the Goldcast. Today I'm joined by Mr. Rick Roll. Rick is the president and CEO of Sprott US Holdings, Inc., and he is a renowned expert on natural resources investing and securities investing. So Rick, thank you for taking the time today for this interview.
Pleasure. Thank you for the opportunity.
Okay, so there's been a lot of uncertainty about paper gold recently among retail investors and the general public as well. Most people who own or buy gold on small volumes have seen that there's unusually high premiums right now on a lot of platforms for small denomination bullion. And there's a lot of speculation about what's causing that. And I think there's also just a lot of unknowns and perplexities about what is paper gold and how does it affect the price of gold and how is all this calculated. And I guess we could start with that. So what is, in your opinion, paper gold, and can you give us a brief overview of that?
I would define paper gold as financial products that are denominated perhaps in physical metal, but aren't represented by ownership of physical metal. So I would define paper gold as everything from a futures contract to a gold denominated ETF, to a deposit receipt or a delivery receipt, that is, any form of gold ownership other than physical gold. Other people would have much more restrictive definitions of paper gold. But when you talk about the dynamics of the gold market today in the context of physical gold, most of the discussion centers around the extraordinary liquidity of the futures market, in particular the near-term futures market. Many days, many days, 100 times the volume of the gold held in the vaults at the Chicago Mercantile Exchange or the LBMA trade. That is, those exchanges frequently trade daily 100% of the gold that is on receipt in those exchanges that covers the underlying trades, which is to say that the trades are all expected to be rolled or cash settled. And one of the nervousnesses that people have is that with the extraordinary imbalance of the collateral relative to the instruments which are issued based on that collateral, if you had a circumstance where even a reasonable number of holders of the near-term contract held for delivery, how would they get filled? How would they get filled? The other nervousness that stems from that part of the paper gold trade is that it is extremely easy to manipulate the near futures market by manipulating the physicals market. You've seen, 15 times in the last 5 years, sellers of very large quantities of physical gold at periods in time when the market was particularly liquid, 2 o'clock in the morning or something. This is obviously not done in an attempt to maximize one's yield on the sale of physical gold. It's done to spoof the paper market. If someone has a laddered futures contract short and can spoof the futures market with a decline in the physical, he or she can settle the shorts into the panic created by the spoof. Now, many people allege that that so-called spoofer might be a great big bank, or might be a government, or might be some cabal trying to suppress the price of gold. My own view is that it is one or more traders who have extraordinary sophistication and who have been manipulating many markets, including LIBOR, for many years. My suspicion is in the future, understand that if you're spoofing or manipulating a market, it's easier to spoof it in the direction that the market wants to go. In the last 10 years, gold has wanted to go lower, so it was easier to spoof it, manipulate the market lower. I suspect now you will see a return to the dynamics that you saw in the early part of the last decade, where markets get spoofed higher. Spoofed,
Right.
to be sure.
So that would basically be a process where they would go on the LBMA or some other like physical, more of a spot trading delivery market, and then that would affect the Comex based on the results from
What
that change.
what likely would happen, and this is conjecture on my part. I'm not active in the futures markets except occasionally to hedge. But what would happen is somebody would establish a laddered long, that is, several expiration dates long position, and then buy spot aggressively, attempting to spoof the market up away from the London fix.
Right.
Um, in other words, a mirror of the trade that you've been seeing for the last 10 years. The bigger underlying concern, which is to say that there isn't sufficient metal to collateralize the positions, I think is a very fair criticism. My suspicion is that if you had a circumstance where there was a real imbalance between claims and inventory, that the exchanges would cash settle. In other words, they would say for somebody who wanted gold, sorry, too bad, so sad, here's the cash equivalent, and buy it.
Right.
There are, of course, other forms of paper gold, Mokata certificates, Perth Mint certificates, in effect, depositor delivery receipts, the ETFs, including the Granddaddy, GLD, and of course the Sprott physical products, which are exchange traded products, which are in certain circumstances redeemable for physical precious metals. I would suggest that all of the products, all of the financial products which are denominated in gold, but are not physical gold, are, in fact, would meet my definition of the phrase paper gold.
Okay, great. So that covered a lot of stuff. So I guess we're mostly talking about Comex right now. So could you give us a little bit of background about Comex specifically? And it's mostly like a platform for derivatives that is for gold. I guess what is the difference between eligible gold and registered gold on Comex?
Yep.
Who owns the gold? All that stuff.
Because the Comex and other exchanges like it treat gold as fungible, meaning that one person's ounce can become another person's ounce, and because in order to maintain, if you will, trust in the system, the only gold available to write contracts against or buy contracts against on Comex is so-called good delivery gold, which is to say gold that has been refined at a certified assay lab and contains agreed upon physical characteristics. When gold is delivered outside of the good delivery system, that is, when somebody takes delivery at their home, not into a bonded warehouse, gold is called out of system. And if you want to re-enter that gold into the system, very often there's a slight discount to compensate the taker for the risk that the bar might be counterfeit, and to accommodate the inspection of the bar, including assaying. So good delivery gold is simply gold that has come into the system, has been tested, and has been verified, where the exchange itself takes secondary responsibility for the liability associated with fraud or counterfeited inventory.
Okay. So who stores the gold at Comex? Where is it stored, and who stores it?
Gold for Comex settlement. I mean, the Comex itself has inventory. The Comex primary dealers have inventory, but gold which is held in member accounts or sometimes client accounts in good delivery facilities around the world can be accommodated in the Comex system, much like in the LBMA system. So there are various licensed and trusted repositories around the world And those inventories can be counted as good delivery for Comex-related contracts.
Hmm.
The amount of gold that actually settles on the Comex relative to the amount of contracts which are outstanding on the Comex are astonishingly small, as you might expect in what's in effect a leveraged long derivatives exchange.
Yeah. So is there a precedent? You mentioned that if a group of people decided to kind of make a run for the gold on the Comex and request delivery, is there a precedent for that happening? Has that ever happened before?
Well, the Hunts tried to corner the silver market in the 70s. And what happened is that the Hunts got control of the forward contract. And it was pretty obvious that they were going to squeeze the shorts, including the institutions that in effect owned the exchange. And the consequence of that was that the exchange changed the rules. the Hunts were leveraged long on margin, and the exchange decided, rather than to insist on cash settlement, to make silver contracts non-marginable, which is to say they gave the Hunts the largest margin call in human history. One would expect that if there actually was an imbalance between calls on physical and the physical available, that the exchange would declare some form of force majeure and go to cash settlement. The exchange itself deciding probably what the appropriate level of cash would be. The sort of dream of the people who believe that the gold price should be higher would be that the gold price would resettle dramatically upward in the case of a failure to deliver. Meaning that a short squeeze left to its own devices without cash settlement around an arbitrary sum would be much higher than the cash that would occur as a consequence of a negotiated cash settlement. I can't comment on that, but it is an interesting circumstance to contemplate. If you think about the amount of outstanding contracts relative to the collateral for settlement, there would be left to their own devices the opportunity for an absolutely epic short squeeze.
Right.
I don't believe that's going to happen myself, because I don't believe that the members of the exchange, who are often short, would allow a circumstance to come about that would result in the bankruptcy of the exchange or the exchange's members. That's not the way oligopolists act.
Right. Makes sense. So I guess you mentioned before, I think warrants and being a part of paper gold is in, if you have the Comex system and you request a delivery. So how can you actually get your gold out of Comex if that was to occur?
Right now, it's not any particular problem. You hold the contract till expiration, and you request physical delivery. You have to pay for physical delivery. If you're a big trader, physical delivery is often from someone else's pallet at the Comex to your pallet. That is, they move gold from one stack to a different stack. But certainly, at Sprott, as an example, when we have major inflows into our physical product, we frequently have to buy 20, 30, 40, $50 million worth of gold a day. And it may be that although we need gold at the Royal Canadian Mint in Canada, that gold is resident in Chicago or New York or London. And so you have to take possession of that gold at the depository that it's at and arrange for transport, good delivery transport, to where it is that you need it. If you do it a lot, like we do, it's not a really complicated process. If you're a normal, living, breathing human being, it's let's just say that you're better off, rolling the contract or liquidating the contract and taking the cash. Certainly, there are repositories, Brinks included, available to living, breathing human beings, where should you hold a contract to maturity and want physical delivery in system, you can do it. but that's a very, very rare event.
Okay, great. So one more thing on the Comex. There was an article recently on Reuters, March 24th, and it said basically the London Bullion Market Association and several major banks that trade gold have asked U.S. exchange operator CME Group, which we discussed is operating Comex, to allow gold bars in London to be used to settle its contracts to ease disruption to trading. So what did you make of that? Is that basically LBMA bailing out Comex? Is that
No, not at all. This is just a circumstance where the London market has been adequately supplied, and the U.S. market hasn't been adequately supplied. It's often the same dealers, the same buyers and sellers in both markets, and we need to move inventory from where it exists in ample supply to where it doesn't exist. One of the things that's been happening for really quite some time has been that there has been disintermediation in gold, which means basically a transfer in hands of gold from 400-ounce London good delivery products. Those products have been bought by private Swiss refiners and re-refined into 25-gram and 100-gram retail products.
right?
And this has been a very prominent trade. In the last 8 weeks, as a consequence of the COVID virus, these Swiss refiners have been shut down, which means that the wholesale inventory, the 400-ounce inventory that London has dealt in, has experienced a temporary hiatus in its traditional purchaser. And the consequence of that is that while the U.S. markets were under inventoried with regards to institutional product, the London market was full, for want of a better phrase, because one of their most important traditional markets, the Swiss refiners, ran out of refining capacity as a consequence of being, shut down for social distancing. That's created impacts around the world because the demand for retail gold and silver products, small denomination products, has been very strong, at the same time that the industry's ability to fabricate it has been very weak. And so you're seeing a circumstance which I've never seen in my life before, where retail physical dealers are paying customers a premium to spot rather than a discount from Sprott to buy the more popular retail products so that they can resell it for even larger premiums.
Yeah.
I've never seen this before, but it makes perfect sense in a market where demand spikes and supply is suddenly non-existent, for there to be a dichotomy in price between the wholesale market, which is pretty well supplied, and the retail market, which is empty inventory.
Okay, so in other words, basically the big premiums on retail products is mostly just to do with the COVID-19 social distancing measures and
extraordinary demand. I mean, demand for retail products this year, really beginning with the incredible stimulus package. I think retail investors began to see the writing on the wall, and in addition to stocking up on toilet paper, decided that they would stock up on gold and silver too. And by a real freak of nature, this demand spike coincided with inventory shrinkage, with the fact that we couldn't fabricate retail investment products fast enough and didn't have any inventory. This circumstance is almost certainly temporary. Let me rephrase that. I'm not an epidemiologist. Assuming that the refiners can find a way to bring their workers back to work and keep them safe, my suspicion is that the premiums in the physical market are substantially high enough that those refineries will be working 24 hours a day, 7 days a week, minting a ton of money, and eventually the market will return in balance.
Mm-hmm. Okay. What did you make of the think it was the head of commodities at Bank of America. I might be wrong on that, predicting $3,000 an ounce gold. Because it sounds like you think there's going to be a correction once the supply starts coming back and they try to take advantage of these high premiums.
I don't think there'll be a collapse in the price. I think there'll be a collapse in the premium. I think that the premium associated with retail product will once again more accurately reflect the gold price.
Right.
I think the gold price is higher. Now, Warren Buffett famously said, of course, that predictions tell you a lot about the predictor and not very much at all about the future.
Yeah.
So perhaps I'm predisposed to believe that. In my experience, the primary determinant of the gold price is real interest rates and the expectation of the maintenance of purchasing power in various savings products. We aren't maintaining any facade as to real interest rates. And anybody who has faith in the ongoing purchasing power of savings instruments in sovereign currencies or sovereign bonds, I would suggest to you is somebody who isn't very good at arithmetic. And so my suspicion is that the pundit, and you named the institution correctly, the Bank of America, was looking at three factors, which I'll recite for you, in terms of being concerned about the purchasing power of conventional savings instruments. The first is quantitative easing. Meyer, if you and I did that, they'd call it counterfeiting and we'd go to jail. Quantitative easing is simply the debasement of the currency, printing up 5 trillion or 6 trillion or some number of currency units unbacked by economic activity or anything else. This is specie conjured up out of thin air. And while you can get away with it for a while, Zimbabwe has proven how well it works over time, and it ain't pretty. The second concern has to be for savers who save in government bonds, as an example, the aggregate levels of government debt. In the United States, there's in excess of $120 trillion in recourse liabilities on the federal government balance sheet, 23 trillion of which are to bondholders, which is to say the so-called government debt. But there's also the whole range of the net present value of entitlements, which the Congressional Budget Office suggests totals over $100 trillion. So anybody who is concerned about the government's ability to pay needs to look at the aggregate debt, which exceeds $120 trillion. That's serviced by the national income, which is taxes and fees minus expenditures. The problem is that that number, the number that we propose to use to pay off the debt, is in deficit. So how do you add a column of negative numbers and come up with a positive sum, particularly a positive sum necessary to extinguish 120 trillion in liabilities? And the answer, of course, is that you don't. The third conundrum, I think, for people who reject the gold thesis is interest rates. Interest is the reward that savers get for postponing their consumption to a later date, and the return that they get for their risk. The world's benchmark savings instrument is the US 10-year Treasury. It pays 65 basis points in yield in a currency that the Congressional Budget Office says is declining in purchasing power by 1.6% a year. Jim Grant calls that return-free risk. Right. And I think the combination of the debasement of the currency via quantitative easing, the balance sheet versus the income statement of the US federal government, and the whole concept of return-free risk means that the wind is very much in gold sails. Again, in my experience, when gold moves, it tends to move pretty dramatically. I remember in the year 2000, gold started the year at about $250 an ounce. And because it was cheap, I had sort of a positive view towards it. I remember thinking, gold, the next 10 years, gold could go up to 700, 800. That was viewed as an outlandish sort of forecast with gold at 250. And I was wrong. It didn't go to 700 or 800. It went to 1800. So while gold's moves might not be frequent, when they move, they tend to be fairly dramatic. I'm not saying that gold will go to 3,000 because I don't know, but I don't think it's an outlandish prediction.
Right. Right. So mostly because of the quantitative easing in that case, that's going to be the biggest effect on the price.
Well, and negative interest rates. You know, if you believed that the U.S. federal government was hyper solvent, and they were paying you an interest rate that compensated you for A, the risk, and B, the depreciation in the currency. You know, if the U.S. 10-year yielded 7, you wouldn't need to own gold, provided that, you know, the debt was in a little better condition. But all those ifs don't occur. We're debasing the currency. Our balance sheet is a wreck compared to our income statement. I mean, a wreck. And we aren't being paid any kind of interest to compensate ourselves for the risk or the time value of money. That's a very, very, very ugly triumvirate if you happen to be a saver. Gold, in my experience, as I say, is traded in other countries a little differently, but really contrary to expectation of the yield on U.S. 10-year treasuries. That's been the most important circumstance. And so one thing that's happened is that the U.S. 10-year treasury has been a very, very, very good long-term investment for 30 years as the interest rate fell. You know, if you owned a 7% bond in a 6% world, you looked pretty good. The interest rate peaked, which is to say the bond price was at its lowest in 1981. The U.S. 10-year treasury paid, I think it was 15.6 then. It's been in a 35-year bear market. Now the 15 is gone. It's just the 0.6 that remains. Now, I would suggest to you that a 35-year-old bull market is very long of tooth, particularly when the value proposition is that you get paid 0.6% in a currency that's deteriorating by 1.6% a year. If the bond market, the U.S. bond market, trades inversely to the gold market, and the bond bull market is, for arithmetic purposes, ending, that suggests that we're early on in a gold bull market.
Right. So what role do central banks play in all of this gold trading as well with LBMA and Comex and everything? Because we're just talking about, you know, the government's going to be printing more money, changing the interest rates through the central banks. Are they going to also buy gold to prop that up? Are they going to be selling their gold? What are they going to be doing with their gold?
I think it depends on the central bank. If you are the Russian central bank or the Chinese central bank or the Iranian central bank, and you are concerned about the extraterritorial nature of U.S. law, in other words, if you don't like your actions and the way you trade constrained, and if you're concerned about the U.S. control of the SWIFT system, the international banking system, then you have a real reason to hold gold as opposed to U.S. dollars as your reserve asset. In other countries that found themselves way long U.S. treasuries, I'm thinking about Korea and China in particular, when you got paid a real rate of interest, 10 years ago, 7 years ago, you had a huge incentive to hold dollars because they were so liquid and they paid a yield. Gold, of course, paying very little yield unless you lease it. But the circumstance begins to change when you are holding U.S. government securities and A, not getting paid for it, and B, watching them get quantitatively eased to the point where you need to begin to be concerned about the purchasing power. Traditionally, gold has been viewed in many parts of the world as a vote of non-confidence in central banks. And central bankers are living, breathing human beings, just like you and me. Votes of non-confidence in finance guys like me or bloggers like you are something that might not sit well with either of us. And so traditionally, central bankers have viewed gold almost as a hostile instrument, despite the fact that they have to own it. And when there were real yields in other asset classes and there were excuses not to hold assets that were in effect a warrant against their performance, they were predisposed not to own gold. The British central bank and the Canadian central banks both famously sold most of their gold holdings well below $1,000 an ounce. turns out probably not a really good move. Do central banks trade in gold? Absolutely. Would I expect the U.S. central bank or the European Union central banks to use some of the proceeds of quantitative easing to support the gold market? No. My belief is that they view gold as a symptom of economic nervousness, and they view an increase in gold price as feeding economic nervousness. And I think that they see their role as promoting economic stability, which an increase in the gold price does not do. I think you will see other banks buy gold, not to support gold, but rather because of a nervousness about the other asset classes which might be available to them.
Right. Okay, great. So you mentioned some of the, I guess, developing countries, Russia, China. Do you see, quantitative easing, inflation, all this stuff, and you said they're going to try and back up their currency more with gold. Could this lead to kind of a de-dollarization in some areas of the world?
I think that would take place over a very long period of time. The U.S. Treasury market, there is still an amazing amount of faith in the United States abroad, and an amazing amount of faith about the United States domestically. I would tell you that simple arithmetic begins to question that faith. Yeah. But I think a reckoning is a long way off. The truth is that we have the most liquid and transparent financial system in the world. And the U.S., despite its woes, looks fairly good compared to other markets. My friend Doug Casey describes the U.S. dollar as the prettiest mare at the slaughterhouse. That's probably a bit extreme. But I remember talking to one very big Asian client about their institution's treasury holdings. And I said, from my point of view as American, I look at this as a tremendous advantage. You guys send us all kinds of cool stuff. Cars, refrigerators, computers, steel. We send you back a bunch of paper with a dream printed on it. To me, that's a hell of a trade. Particularly when I think about the interest rate that you get by way of compensation. It just sort of feels dishonest. And I remember he sort of smiled and looked at me. And he says, yes, in fact, it's probably a certificated lie. But it's the deepest and most liquid lie that we're told. And so then I asked him, and this is a very big investor, or he represents a very big institution. I said, do you trust us? And he said, oh, no, but we trust you much more than we trust each other. And I think part of the strength of the U.S. economy and the U.S. dollar as the world's reserve currency, and the U.S. 10-year Treasury as the world's benchmark security, has to do with the lack of viable alternatives. The transparency of the U.S. financial system, which is extraordinary, and the liquidity that's available in U.S. dollars and U.S. treasuries. For myself, I haven't decided to be gold-backed, but I certainly own more gold than most people. And one would argue, other than fear, because I'm the largest shareholder in Sprott Inc., which is in effect a brand name for gold investing. If gold does well, I'll do well anyway. But that notwithstanding, owning gold feels to me like catastrophe insurance. It helps me sleep nights and stay calm. And at my age, sleeping nights is a good thing.
All right. Okay, yeah. So I guess that's a pretty good summary of, the U.S. financial system. So back to the LBMA for a quick moment. So apparently some of the gold in the LBMA is considered unallocated. Can you explain what does that mean, and does this gold exist?
Does the gold exist? Yes. What people who say it doesn't exist are probably referring to is that relative to the number of times that ounce or gram has been certificated, the amount of gold relative to the instruments that have been issued against it is infinitesimal. It's truly infinitesimal. And the suggestion are that there may be, and I'm making this number up, so don't write a headline around this. It may be that a kilo of gold held at the LBMA is owned 100 times.
Yeah.
And in that sense, I think there are legitimate worries. I would rather see an exchange that deals in that many contracts require the brokers who are guaranteeing the contracts and require the exchange itself to have a larger inventory of material available to settle contracts.
Yeah.
That's a personal preference. When you go and you do a transaction there, they make no promises as to the sense that if you have a 50,000 ounce contract, that they have 50,000 physical ounces set aside to match your contract and every other contract outstanding. It wouldn't surprise me if the outstanding promises, and I don't know that this is the number, but it wouldn't surprise me if the preponderance of long contracts, as an example, over short contracts or anything like that, if outside the delta, it wouldn't surprise me if the hypothecations exceeded the collateral by 20 to 1.
Right. So, okay. So besides basically covering the liabilities more, what other solutions or improvements do you think could be made to both of these areas? And do you think there should be more regulation and oversight, or do you think it should be more of a competition-based? Because you described it also as
competition-based. Regulation always serves first to benefit the regulator, and then after regulatory capture happens by the institution, it benefits the institution. I believe in free markets, and I believe in full and fair disclosure. I believe that the Comex and the LBMA in 10 years will go the way of the dodo bird, because I believe that any uniform commodity trading, which is to say gold, silver, platinum, palladium, good delivery copper, all of that, I think, will be evidenced by distributed ledger receipts on the blockchain. And I think that by utilizing the technology, that you yourself would be able to see the collateral associated with the obligations that you had bought and sold. The whole secrecy of the exchange process, which benefits the traders and the brokers, is technologically obsolete. It used to be that the brokers and the traders had the knowledge, and you paid them to exercise that knowledge on your behalf. There's no particular reason anymore, particularly for someone your age that has grown up with technology. There's no particular reason to assign a monopoly on knowledge and technique artificially. And my suspicion is that while it won't happen for a long time, because it's not in the industry's interest to see that monopoly go away, the demand from savers of your age with access to technology will make it go away. The idea where gold, that as an example we held at the Royal Canadian Mint, could have receipts, distributed ledger receipts, blockchain receipts against it, and in a circumstance where transactions occurred technologically and were verified on a blockchain, my suspicion is that all of the exchanges will, within 10 years of today's date, go away. And my suspicion is that that market will be deeper and more efficient. Doesn't mean that that market might not blow up. If you gave me, as a consequence of our transaction, the right to rehypothecate gold that I held for you, there's no reason why I couldn't leverage it 20 to 1 with your permission too. And there's nothing to suggest that you yourself would care enough to research the liability that you had sold by doing that. But the tools would be readily available to you.
Right. Have you, do you have any particular projects in the blockchain world that have caught your eye, or do you think this is still something that right now most of what's being done in blockchain is like an experimental basis, and then
No, Sprott has invested about $5 million in various distributed ledger technologies and platforms around gold. We have a product we've invested in called One Gold, which is in partnership with AppMex, which is a very large retail physical precious metals dealer, where there are delivery receipts which are sold to gold buyers, and the delivery receipts represent ounce for ounce gold on deposit at the Royal Canadian Mint. And these delivery receipts can be surrendered to registered dealers for delivery of physical product. We have a different product that we've invested in conjunction with IEX, the automated exchange operators, the guys from Flash Boys, which is also a blockchain distributed ledger delivery receipt product. Most of the major gold companies in the world are also shareholders in this, and they deliver good delivery gold to the Royal Canadian Mint, and again sell delivery receipts that are evidenced by physical gold that are on deposit. We have invested in a couple of different coin projects, which would deal much more freely in tethered coin products denominated in gold and silver. It makes perfect sense. You know, Sprott manages about $7 billion in New York Stock Exchange traded physical precious metals trusts, gold, silver, and platinum and palladium. And unlike the ETFs, our products are in certain circumstances redeemable for physical products. So we're in that business already. If the future of that business is the distributed ledger, with our brand, we have to be there. We have to make it more efficient for our customers. I have no idea what products or platforms are the ones that will be successful 10 years from now.
Right.
But the idea that you, as a young person with access to technology, would confine yourself to a system that's inefficient, is as inefficient as the system that my generation invented, particularly merely to subsidize our monopoly on knowledge and technique. Pretty stupid.
Okay, wow. Yeah, that seems like a great area for blockchain technology. I know, like you said, there's a lot of projects already in that area. What do you think are, maybe this can be the last question, I don't want to take too much of your time. What do you think are some of the trends that we're going to see in the future blockchain solutions? What would you be looking for in some blockchain?
I have to beg off that question. I'm 67 years old. I would describe myself as an inadvertent Luddite. I'm a fan of technology, but I wouldn't describe myself as being competent.
Right.
I'm financially competent, and I have analytical skills, including technical analytical skills. But I'm afraid that my information technology skills relative to yours are probably laughable. I can see problems that need to be solved fairly well. I'm good at spotting market inefficiencies, but I'm occasionally troubled by finding the on switch with a computer or operating a toggle switch on a wall. So imagining how to solve these problems is beyond me.
Okay. All right. Well, that's fine. No worries. Yeah, so that was a really interesting interview, and it really cleared up a lot of stuff for me and helped for viewers as well. So thank you, Rick. Really appreciate your time.
I would urge your viewers who are interested in what we do, particularly those who hold natural resource stocks, if I may make them an offer, I am happy to rank your viewers' natural resource equities portfolio for free, no obligation. If they email me at rankings, rankings, at sprottglobal.com, with the names and symbols of the companies in the text, not as an attachment that my IT guys won't let me open. I'll rank those companies 1 through 10, and I'll comment on those ones where I think my comments are germane. And I'll include a wonderful 50-year chart of the gold mining equities index and a 100-year commodity chart and send them back. It's a wonderful service that we've been able to offer people who are curious about precious metals but might lack the expertise or the technique to understand the companies or the markets.
Okay, great. So we'll definitely put the link in the description, and thank you for the offer as well.
Thank you. Thanks for the opportunity.
All right. Cheers.
Thank you.